Man, I feel like I am the Federal Reserve. I'm serious. I am buying up assets, dividend stocks, almost every day now. I made 3 stock purchases this week. I bought more shares on Monday of Johnson & Johnson. On Thursday, I purchased 3M. And on Friday, today, I purchased StarBucks. So 3 out of 5 trading days buying up assets. And last week, if you've been following my videos, I purchased stocks every single day. So crazy market, and I continue to dollar cost average into very high quality dividend stocks. Stocks that are on my ride or die list. These are my favorite dividend stocks, the ones that I like the most, the ones that are the strongest, and I'm buying them in these crazy markets. So I'm going to talk about that today. I'm going to give an update on my purchasing strategy. Also today, I was inspired. I was inspired by my man, Mike the Investor. So shout out Mike. He did a tweet. I'm going to share that on the screen, spreading positivity today. We need positivity right now because it is crazy out there. I'm not just talking about the stock market. I'm talking about life. I want to talk about that today. I want to talk about why things are so crazy now and it's so different than 2009, than the Great Recession. Things are a lot different in this collapse, this 2020 economic and virus and health-related collapse. It is a lot different than anything in the past. And so I want to share why it's different, what I'm learning, how I'm challenging myself to keep up the positivity, and some of the mistakes I'm making along the way as well that I'm catching myself with almost every day. I'm going to talk about that today and how it all plays into my investing. I also today want to cover some analysis, some fundamental dividend stock analysis. I'm going to go into 3M and Honeywell a bit. I want to go into some analysis because it helps answer some questions I have been receiving from the community. I'm going to go into my ride or die stock list, and I'm going to close out today with some thoughts on what's ahead, what's to come in the future. So get ready, another exciting dividend investing video. All right, so let's start with the fun stuff. I'm going to share it on the screen right now. Here are the stocks that I have purchased recently. I'm actually going to show the last 2 weeks of trades so you get a flavor of what's going on. All right, so this week, my best purchase, in my humble opinion, was on Monday when the stock market was tanking, and I picked up Johnson & Johnson. I got it at $116.81, and the starting dividend yield there, it's not that exciting. It's 3.25%, but I'm pretty certain that Johnson & Johnson will continue to raise its dividend each year into the future. And so that dividend yield on cost will grow substantially over time, in my humble opinion. That's why J&J is my number one favorite stock. I like buying this stock here because it's sheltered from the turmoil that is created by this nasty virus. It's a healthcare company. People need healthcare products right now, the types of drugs and devices and products that Johnson & Johnson makes. So I think they'll weather this storm and future storms quite well. The EPS estimate is $8.94 for this year. And so that places it at a 2020 PE of 13.07. It has a very low payout ratio as well, which indicates room to grow the dividend. I already have J&J as my number one position. It's the biggest position in my portfolio. On any kind of weakness, I'm adding more of this thing. I'm doing it. And now it's back up from where it was on Monday. It's back up in the 120s again. That being said, even where it's at now, I feel like it's a reasonable value in this kind of range, and so I'll probably be adding more. I'm really excited to add more J&J here at these levels, but certainly if it dips down into the teens again, man, I am all over it. So that was my favorite purchase of the week, probably my favorite purchase of the last 2 weeks. Now on Tuesday and Wednesday, the market rallied a lot, and so I started getting kind of in this mind state where, hey, it's probably going to come back down, so I should wait a bit. Now, what's funny is on Thursday, psychologically speaking, it just kept going up, up, and up. And so at that point, I made a FOMO purchase, fear of missing out, FOMO. I just went for 3M, and I bought 3M at 133.49. And you can see this is more expensive than where I bought it last week. Last week, I first bought it at 132, and then I bought lower at 125. But the reason I bought 3M on Thursday is despite the market going up a lot, this is the one that was still kind of staying a bit lower. It hadn't gone up too much and is still a really solid value because just last week, I purchased a tranche at 132.35, another at 125.42. And so I felt comfortable buying more shares on Thursday at 133.49, despite the overall broader market going up. But quite frankly, it was a little bit of a FOMO purchase because the market just kept going up. This is why dollar cost average, I can't time the market. But I am pretty sure, at least in my opinion, my humble opinion, I think that the market is probably going to trend down further from here. That being said, we shall see. I'm going to talk about some stuff at the end of the video today that the government is doing that is unprecedented. It's just as unprecedented as this crazy virus, and all of the action that the government and the Federal Reserve are taking. Quite frankly, maybe the market is going to find a solid foundation here in the coming weeks, a lot higher than a lot of us previously thought. We shall see, and that's why I continue to dollar cost average. Anyways, my purchase in 3M is at a 4.4% yield. That's a starting yield, and these guys raise their dividend each year. I anticipate they will continue to do that. I think increases in the next few years are going to be a lot slower until we get into a new economic cycle, but 4.4% starting yield, hey, they don't have to raise it very quickly. I'm happy with that alone. That's a fabulous starting yield. The PE is a 14.53, although each week I'm measuring 3M, the analyst estimates keep going down and down and down, and I don't think they've found their bottom yet. The analyst EPS, earnings per share estimates for 2020, they keep going down. They're going to go down more. So that PE, it's actually probably higher than it looks here. Instead of being 14.53, maybe it's up there at 16, something like that. So in reality for 2020, that said, it's still a bargain. Payout ratio, 64%. Payout ratio is actually getting up there, and that's why it's not horrible, but I don't think they're going to be increasing the dividend too much. So that is 3M. But what happened is today is Friday. The market started falling again. I like to buy on down days. I noticed that SBUX, I wasn't really going to buy it, but I wanted to buy more. But then I was like, Ian, if it really starts falling, I'll go for it. And so what happened is I was watching it, and at the end of the day, the last hour of trading, it started falling again. When it was down 5%, that's when I was like, you know what, I'll add some more shares. So I bought more SBUX. I bought more SBUX at $66 today, 26 cents. Now, this is higher than my tranches last week. Last week I bought it at $58.90 and again at $51.22. SBUX did announce they're buying back a lot of shares, so it may be because they're buying their own shares back that it's helping to hold up the price. Also, the market has just rallied, and this is one of the most premium companies around, in my humble opinion. And so investors are fleeing towards quality. That's one of the reasons I think that this one is held strong. Now, let's look at some numbers really quick. The dividend yield is a 2.48% starting yield, although they raise the dividend each year. This is not going to give me a lot of current yield. It just won't. But in the long run, this is a grower. This one will grow their dividend very aggressively over time. So low starting yield, high dividend growth rate. And so the earnings per share estimate for 2020 is $2.64. But again, it's like 3M. I look at the thing each week and it keeps notching down. The analysts keep revising their estimate. And so it places the 2020 PE at a 25. Personally, I think the 2020 PE could be anywhere between 25 and 40. And so depends how long this pandemic goes on. Depends how long we're all cooped up at home. How long they have to keep the restaurants closed. They have all their stores now, more or less, I think, are closed down for in-store. But takeaway, takeout, drive-through, that is open at some locations. And some locations that are in supermarkets, to my understanding, are still open. But needless to say, revenue, earnings, they're going to be horrible for the near future. And so The way I look at Starbucks, though, it's kind of like a spring. The PE this year, for all I know, like I said, could be 40, but I'm looking more 2021, 2022. Can they shoulder this crisis? Yes. When we get through it, what's the PE going to be? What kind of PE am I buying here? I'm probably buying at like a PE of 20, which I feel is not bargain basement, but it's a fair PE for premium quality. And I really want to grow this position. I want to basically double or triple the size of this position in my portfolio, so I'm willing to pay a fair PE. And as mentioned in my last video, I am now averaging in kind of bite-sized increments. If you will, I am building my portfolio brick by brick. I am doing this because the market is unpredictable now. I am doing this, quite frankly, kind of keep in the game, kind of keep myself motivated. If I know I'm going to be buying something almost every day, it's just fun for me. It keeps me more engaged in the market and just more of a positive attitude towards the market than if I were waiting longer. If I were waiting longer and I just kind of see my portfolio value shrinking each day over and over and over, it's stressful. It's kind of, it's madness in some ways, but if I see my portfolio value shrinking each and every day, but I'm able just to keep averaging in each and every day, I feel good. I feel real good. And so it's a little bit of a trick. And what I'm doing is I'm taking my normal tranche size, shrinking it way down, and I'm purchasing smaller bite-sized tranches in my favorite stocks these days. So that's one of the ways I have amended my purchasing strategy. And so you can see here that I have averages. My average yield on cost, 3.38%. Average PE of the positions purchased, 17.56. Last week was a little better. My average yield on cost, starting yield on cost, 3.83% with a PE of in the 16.83. This was a more expensive week, other than Monday, to buy into the market. The biggest mistake I made this week is buying one stock on Monday. I just bought J&J, and I'm happy I did. It's my favorite stock, and I got a great price, but I would say the rest of the days were more expensive, and so Monday it would have been a good day to buy other stocks, add multiple stocks in one day. But that being said, I don't think this is the last of it. I think we're probably going to have another Monday. We'll have that. Maybe not this upcoming Monday, but at some point we're going to have another one of those days. We're still, in my opinion, in this kind of period of recession, in this period of correction. I think we're going to have another one of those days. And so I'm ready. I'm ready. And I'm going strong here. I'm going strong. Like I said in my last video, I'm buying here aggressively. But when the market does rebound, I'm going to slow down and start stockpiling some savings and cash. I'm certainly not dipping into my emergency fund now. I'm probably going a little more aggressive in my buying habits than I would otherwise. But hey, the opportunities are there. Long-term investor, buy and hold forever, building cash flow. Literally, each time I buy, my cash flow notches up that I can use to pay bills and live. I love it. So that's the first segment of today's video. Share in the comments below if you're buying stocks. What are you buying? If you're waiting, how long are you waiting? What are you waiting for? Let's drive the discussion, because the discussion is my favorite part of this community. I love you all. All right. I want to move on to I don't talk about this kind of stuff as much anymore. It's mostly been numbers here recently, but I want to talk about the psychology of it all, because this is a difficult time for people. Obviously, everyone's scared of catching this virus. A lot of people, my heart goes out to them. Obviously, on the virus side, my heart goes out, and on the doctors, nurses, sanitation workers, store clerks, delivery drivers, all of those heroes, my heart goes out to all of them, all part of the solution. That stuff alone is enough to have some fear. But there's also just more fear because the media is hyping stuff up. There's a lot of challenge out there right now because people are just fearful of their job. And some people, unfortunately, are losing their job. I pray that the jobs come back quickly when all of this stuff gets resolved. It's really scary times. And then a lot of us, like myself, it just kind of is tough being home all day, being cooped up, like you guys know, I always like to go to Starbucks, can't go to Starbucks anymore. And so it's kind of crazy. And so even putting aside the money side of things right now, life is a bit stressful. But you factor in the money side and you see a shrinking portfolio. I've gotten used to that more or less. It doesn't faze me because, again, I invest for cash flow, for long-term cash flow. Capital appreciation is nice, but in the short run, honestly, I like buying some bargains. But I'll tell you what's happening to me that's making it a little crazy, making it a little maybe more stressful than it would be otherwise. There's a fundamental change right now that is happening that is so different than the Great Recession, than the financial system collapse of 2009. What's happening now that is so different is the internet. It's that we all have smartphones. It's that we have social media networks, and in real time, we are all being bombarded. We're being bombarded by the media, and even people with good intentions. They're sharing their stock trades, like me. I'm sharing all of my stock trades out there, or most of them, to my knowledge, on Twitter. And what's happening is it's almost becoming a little bit of a competition. People will see it and they're like, well, I got it at a better price. Or I see it, I just look, I'm like, I just bought this one and man, I missed out. This guy got it at a better price. And so I want to share a tweet on the screen right now, actually. This one is from a community member, and I love this because this particular tweet is insightful. So I actually just started using humor. I found that one of the best solutions for these times to keep my head in the game, to keep me focused, is just to interject humor into it all. And so I told it like it was. On Thursday, I FOMO bought 3M. Total fear of missing out, bought it. What if the market keeps running up? And so I made a joke about it. And what my friend Anders responded, shout out if you're watching, my friend. Thank you for your response. This is really important what you said. And what he said is, who cares if they plummet again? It's not going to go under. You're building wealth. You're not competing. This is the key thing. You are not competing. I want to point this out to everyone here. We're not competing. None of us are competing. We're all in very different situations. We all have very different goals. We all have very different preferences on the types of investment strategies that we're taking. And it becomes tough, though, when you're kind of like a type A personality like myself. You're kind of used to competing. You're out there kind of fighting your way up the corporate ladder or working really hard towards a certain goal. I've found that I've always been a somewhat competitive person. And so it's hard sometimes in an era of social media to not compete. And so the reminder that my friend Anders shared with all of us is something I really just want to echo in the video today. And I think it gave me a lot of peace, and I hope it gives other people peace out there that we're not in a competition. And yeah, 3M, I bought it here. It may plummet. And if it does, I can buy more. But you know what? I'm happy with this price. And over the long term, it's going to work out very well for me. So I also want to just share some more things on the screen right now as it pertains to this whole concept of just the psychology and the overwhelming nature of what's happening right now. And so this is so different, again, than 2009. And it's interesting. From each collapse, we're going to learn something different. It's never going to be the same each time. But almost where I'm at right now is because of the barrage of media coverage, because of just social media. I'm going to probably take a step back personally over the next week. I want to challenge myself. I was talking to my friend Joe about this on the phone the other day. Shout out my friend Joe. And next week, for example, I may not be on Twitter or Facebook. Now, I will probably post my trades there, but other than that, I'm going to go in to post them and I'm going to get out. I'm just going to get out and go do my thing, because we talk about sin stocks here sometimes. And I think sometimes people got sin stocks all wrong. And now I'm just saying, is social media a sin stock? I think it might be one of the bigger sin stocks. I don't know. And so it's just the nature of it all. It's hard to stop checking it. It becomes competitive. There's too much media, and it just messes with people during this collapse. And it's so different. I'll tell you, back in 2009, I wasn't even checking stocks every day. Oh, there are days go by I wouldn't check it. I certainly wasn't on social media, maybe like once a week or something. And so all I'm saying is, this is different. It's a different beast. But realizing that, the solution for me is I'm going to take a step back. Now, obviously, my video schedule will be the same, and I will probably log in to share trades and such. But I do apologize in advance if you message me or tweet me. I probably won't be checking next week because I want to challenge myself to focus on what's important. I'm at home right now. I should be spending more time with my kids. I should be writing my book. I should be doing other stuff than being so kind of checking social media every minute. So something I've learned, a big lesson I've learned so far from this collapse that's different from the last one. Now, something else that I really want to focus on here is joking and humor as well. I'll tell you, this has come up now not only on social media. I actually posted a tweet the other day, and it was a little bit negative. I was criticizing people who are short sellers. And quite frankly, sometimes it's okay to believe something and not share it publicly. That's one of those situations. And so I got love for all investors, short sellers or not. But I had a critique. But afterwards, I was like, you know what? I'm just going to take it down because it's not positive. Like Mike the investor, I should just be focused on the positive. And so that happened. I've also noticed even at work, we are all working now such long hours to pure exhaustion. Seriously, I'm working around the clock. And it's created in some situations more tension, more friction. And so what I've learned out of all of this is it's better to take a step back. And I want to just start interjecting more humor into my life as well. I think a lot of us are forgetting the bigger picture because of this thing. And so just some random thoughts for you all today, but that's what I'm doing. I'm obviously going to be focused more on my exercise, kind of just projects around the house, taking time for myself, getting appropriate sleep, focusing on the long term, all of that good stuff. Because I'll even tell you, put 2009 aside, before this whole virus thing, there were weeks just in the past year where I didn't really go into Twitter much. Maybe I'd post one tweet a week and I wouldn't even really look at anything else. And I'd maybe there were weeks that went by I bought no stocks. And so I miss those times because those were the times where I was just focused on life. Isn't the point of dividend investing living life after all? And so it's so different now. I don't know. Put in the comments below if you guys are facing those challenges like I am. I certainly am facing some of those challenges, but I like the challenge because I'm learning from it. Anyways, I digress. So I want to jump now into some fundamental dividend stock analysis of 3M and Honeywell. And I'm going to start with 3M. By the way, the reason I'm including Honeywell is I was thinking about buying some Honeywell, and that would be deviating from my strategy. It's not a ride or die. And that's why I do these analyses, because after doing the analysis, I decided, you know what, Ian? Honeywell's not a ride or die for a reason. It's not on the list. Don't buy it. And so I was even thinking yesterday, Ian, I'm going to give yourself a little bit of leeway to buy maybe one trade a week, something that's not on the ride or die list. I was trying to fight my strategy. No, after this analysis of Honeywell, it's a prime example why I got to stick to the strategy. And so let's look at 3M first. What do I want to look at? First thing I want to do with 3M is I got a criticism online saying, Ian, you shouldn't buy 3M because the balance sheet is no good. And so, hey, you know what I'm starting to do? The old Ian, or even the Ian of earlier today, people have been criticizing stuff I do at work or the trades I'm making. I've been kind of lashing out. That's a mind state I've been in because not even the financial side of things. It's just being cooped up like this it is not good. And so I'm not even an extrovert. I'm more of an introvert. I can't imagine how hard this is for an extrovert to be stuck like this at home all day. It's gotta end. It's gotta end sooner than later. And so anyways, what I would say though is that's been my knee-jerk reaction is someone criticizes it. Oh, I must be right. And so I'm going back and fighting it. But my smarter side of me tells me, Ian, you get a criticism, let's look into it. Let's take it seriously and see if there's something to be learned. And so when someone said the balance sheet 3M no good, hey, let's look into it. And so I'm going to bring it up, balance sheet. Let's look right now at 3M's balance sheet. And so I'm popping it on the screen. And I think the biggest criticism of 3M's balance sheet is the debt level. Look, they don't have a lot of cash. Thankfully, assets are greater than liabilities, so they have shareholders' equity. Shareholders' equity is not represented here, but you can see assets are $44.6 billion, liabilities 34.5, so they got positive equity, which is good. Cash is low. Why is the cash low? The reason the cash is low, in my humble opinion, is they pay a heavy dividend. They give the cash back to the shareholders. If they stop paying a dividend, they could stockpile cash. They could have an even better balance sheet. That's always an option for them. They don't do that because they're a dividend company. But I think the criticism that this person was making is that, look, my concern, Ian, is they got $2.3 billion in cash. They got $17.5 billion in long-term debt. What happens when revenue dries up, when earnings dry up because of this virus? And so we'll talk about that, by the way. We'll talk about something else about them in a minute. I want to talk about their business divisions because that's a whole other topic. But before I get to that, that's the concern on the balance sheet. And I think, hey, fair concern. So let's look into this a little bit more. And so what I did next is I started looking into the statement of cash flows. And so I'm going to share that on the screen with you all as well. And so on the cash flows, what you start seeing is in 2019, cash from operations was about $7 billion. And this will probably come down. Maybe in 2020, it'll be, say, $5 billion, $4 billion, somewhere in that range. I'm ready for it. I'm ready for cash flows from operating activities to plummet. And we'll talk about that in a minute. But the reason I'm ready for it to plummet is masks are not this entire company. Medical gear is not the entire company. They do a lot in aerospace and industry. Those revenues are going to drop like crazy. They're going to get crushed. I believe, at least. So it's a mixed bag with this company because it's across multiple divisions. And I'm not fooling myself. The numbers this year, they're going to be helped by the masks and the medical stuff, but they're going to be hurt by a lot of other stuff. We'll get to it in a minute. But so I think the cash from operations, maybe it'll go from $7 billion down to $5 or $4. Cash flows from investing, I think it's going to be pretty neutral this year. So it was a minus $6 billion last year. They were doing some acquisitions and such last year. This year, I don't think they're going to be making a lot of investments. And so I think that'll be a pretty neutral bucket. Cash flows from financing, the dividends are in here. So you got $3.3 billion of dividends. That's going to be there. And so I know this bucket's probably going to have that. And last year, they were doing some weird stuff. They had proceeds from debt because they were probably cash out refinancing debt. But they also had purchase of treasury stock. I don't know if they're going to do a lot of that this year. And they had repayment of debt as well. Long story short, the way I'm looking at the bucket this year, again, there's a lot going on here, but the two fundamental things I'm most concerned about are dividends and debt payments. And so I know what the dividends are. It's probably going to be like $3.3 billion. Debt, it's really freaking unclear from here what's going on, what it's going to be. And so what I did is I actually dig deeper. I dig deeper past the cash flow statement. And so let me pull that up in a minute for all of you. All right. And so I'm going to share this on the screen now. This is within their footnotes. I found some information on the debt. And so, because it's really unclear based on the cash flows what the debt repayment's going to cost. And so if I look at this on average, long-term debt, they got about $19 billion from this screenshot at least. The effective interest rate on most of it is 3%. On the short-term debt, They have about 2.8 billion or something. It looks like on the majority of that, interest rate is in the high 3%. So basically from here, it seems that they have about $22 billion in debt. I'm just going to do a quick back of envelope calculation. It looks like, to me, like most of the debt is at this 3% range. If I take a 22 billion, I multiply by 3%, the debt service comes out to about 660 million a year, plus or minus a few hundred million either way. The debt service is in that $660 million range. Okay, so let me pull the cash flows back up now. I'm going to pull up the statement of cash flow really quick. And when I do that, again, I'm going to pop down to the category that says cash flows from financing. I know that there's 3.3 billion from dividends. I know there's another, say, 680, let's round up 700 million or so from debt interest servicing. If I add those up, I'm at about a negative 4 billion for this category. And so, yeah, they could do some other like cash out refinance or this or that or something, but let's just take it as is. Let's say this category, cash flows from financing, is negative 4 billion. Okay. Like I said in the top line bucket, I think that their cash flows from operations might dip from 7 billion down to 4 or 5. Okay, I know from investing activities, I think it's going to be 0 this year, neutral. And from financing, I think it's going to be a negative 4. I think in the worst case, 3M cash flow wise is covering it all. They're making ends meet. And so when someone tells me they have a bad balance sheet, I think it's a reasonable criticism. I think it would be nice to see more cash on the balance sheet, less debt. But personally, maybe I'm looking at it differently than other people. But when I look at it fundamentally like this, I feel all right about 3M. I feel like even in a bad market, more or less, they're going to make ends meet. Let's say things get really bad. Let's say that their cash flows this year are down from 7 billion. Let's say it just gets clobbered down to only 3 billion. Then they're only negative cash flowing 1 billion for 1 year of time. And I think that would be about as bad as things could get. And then 2021, 2022, 2023 comes around, things get back to normal. And so this is why I feel comfortable buying 3M here. I'm not too concerned about the balance sheet, and I don't think it's a bad balance sheet. I have companies, quite frankly, where I think the balance sheet is not that good. I'll give you an example. AbbVie. I love you, AbbVie, but your balance sheet's not that good. And so 3M, that's why they're on my ride or die. I don't get overly concerned by 3M. And so I want to go in now into some more stuff, some more fundamental stuff on 3M. And so one of the other things that I wanted to understand for myself is just how much risk am I really exposing myself to here? How much downside is there? And so I started looking for 3M. How do they diversify across industry groups? Let me pop that on the screen. I want to show you really quickly. I did find some more information about their operating segments. And so 3M, safety and industrial is 36% of the business. Transportation and electronics is 29% of the business. Healthcare, 23%. Consumer, 15.8%. And then some other junk. Basically, the way I look at this is a safety and industrial. Some of that's going to do really well right now because I don't know what's included in there, but anything related to safety in a global crisis pandemic, all this fear out there. Fear is a liar, as my buddy told me. But hey, it's out there. That's probably going to do all right. Transportation and electronics, 30% of their business. I wouldn't be surprised if this revenue goes from 9.6 billion down to like 1 billion. Hey, I don't think anyone's building autos or buying autos right now. I'm sorry. It's just, I don't think it's a hot market for autos right now. Healthcare, 23% of the business, it's going to do well. It is going to do real well. And I'm proud of 3M for that. Consumer, it'll probably do okay. There's probably certain things in consumer like Post-it notes. I don't think that's very popular right now, or those command hooks. I don't think that's very popular. No one's thinking about that now. They're thinking about safety. There's certain things in consumer, probably related to protection and healthcare and such, that are doing fine. And so net, when I look at this, the biggest risk is at 30% of the business on transportation and electronics. I'd say there's some risk tied into consumer. But in general, when I look at this, I'd say, hey, maybe about 60, 70% of their business is okay in this economy. Maybe 30 or 40% of their business is at risk in this economy. And so I look at this, hey, that's why it's plummeting. That's why it's trading where it is. There is business risk here. This isn't a mask company. This is a diversified company that has exposure to pockets of risk. I have to be real with myself. Also, I started looking at geography. I'll pop this on the screen right now. And so I start looking at geography for 3M, and it looks like 40% is US, 30 Asia Pacific, 20 Europe, 9.2 Latin America and Canada. There's some risk here. I'm not going to lie. There are political tensions now with China. And so I hope that dissipates, honestly. From an investing standpoint, I got some exposure. Of this Asia Pacific, I don't know how much here is China, but that's 30% of their business. That's some risk. Europe, it'll come back, but right now that's a risk for 2020 because Europe is on lockdown, more so than the US from what I've heard. Heart and prayers out to all of my European subscribers. I love you all, and it's sad. I'd love to live in a world again where it's possible to visit Europe because I love Europe. London, Paris, two of my favorite cities in the entire world. But there's some risk, so I'm not going to fool myself. It's really important as a dividend investor to look at the financial reports like this because maybe it doesn't even change what I'm doing. Well, sometimes it does, but for 3M it won't. But at least I'm aware, hey, there's risk there, and I'm not going to go in and buy more 3M fooling myself thinking that, oh, it's going to snap back. No, they've got business segment risk and they have geo risk as well. But it's better than Honeywell, and that's why they're on my ride or die. So with that note, I want to start talking about Honeywell a bit. So first with Honeywell, I want to share just a summary of that stock on the screen right now. For this video, I haven't even prepared it yet. I'm going to prepare it after I film the video. So what you see on the screen now, I haven't even seen yet. But the reason I'm bringing up Honeywell again is I was thinking earlier this week, should I make an exception and buy more Honeywell? It's not on my ride or die list. And ultimately, I was like, well, you know what, Ian? Compare it to 3M. Compare it on business segments. Compare it on geographies and allow that to drive your decision. Don't do it based on your gut. Don't do it based on, oh, it's a small position in your portfolio and you need to build it up. Don't do that junk in this kind of market. Look at the data. And so I look at the data, and I want to show that on the screen right now. I'm going to show you the business segments. And so with Honeywell, they have aerospace. They don't show percentages here, by the way, and I didn't even calculate. But check this out. Aerospace, 14 billion of the 36.7 billion. Sorry, that's gone. And by the way, I don't want to seem insensitive here. If you work in the auto industry or the aerospace industry, I invest in those industries. I love those industries. I feel sad for those industries. I pray that they recover quickly. And so I definitely don't want to seem insensitive. My heart is with anyone in any industry that is facing challenge now. And it's just terrible. It's just terrible what's happening. And I pray that we can get back to work sooner than later. Aerospace anyways, I just don't think that the forecast for this year, unfortunately, is going to be very good for Honeywell. And they're very heavy in that space. Building technologies, 5.7 billion. I don't know. I don't think that there's going to be as much construction and renovation happening immediately. I don't know, though. Honeywell sells a lot of stuff at one of my favorite stocks, the Home Depot. We'll see. We'll just see there. I mean, you need a new hot water heater. The one we got when ours broke has a Honeywell gizmo on it, a Honeywell control panel. And so who knows? Maybe some of this building and home stuff will do, but I just think I just think it's probably going to trend down there. I think that's a riskier part of their business. Performance materials and technologies, 10.8 billion. It's probably at risk too. Again, it's all related to industry, to commerce, to building, to expansion. We're just not in that economy now. We're in an economy where the things that are thriving are healthcare, safety, food, certain big box retailers, that kind of stuff. Industrials, there is some risk now. And so the last category is safety and productivity solutions at $6 billion. I think that category is going to do fine. That it probably includes where they're making their masks, because Honeywell does it too, just like 3M. When I look at this, look, percentages aren't even here. Doing my best to do this thug lifestyle, get it done quick, back of envelope, save me time, you time. When I look at Honeywell, I'm just telling you, there's a lot more at risk here than with 3M, in my humble opinion, because 3M has the heavy healthcare exposure and has just does not have the kind of exposure to aerospace that you see on a percentage basis that you see at Honeywell. So this alone was enough to keep me away from Honeywell. That said, if Honeywell gets as low as it was on Monday again, I'll probably consider it. It was down in that it just had plummeted. But this one is going to take longer to snap back, in my humble opinion, than 3M. And this is just how I do it. I look at this stuff and it helps inform me what belongs on my ride or die list. And it reconfirms with me, Ian, don't have a strategy and go do the other thing. Stick with your strategy. And so this is why I will stick with it. And I won't be averaging into Honeywell here. I'll be averaging into my ride or die stocks. It's a new type of market. I'm learning more than I ever had before in a quicker time than ever before. Quite frankly, probably fueled by all of this media, social interconnectedness of everything. Market's more volatile than I've ever seen. And so it's furthering my learning very quickly. And I got to stick with my ride or die to make it through all of this thing. And eventually, ride or die, hopefully, will be about 75% of my portfolio. That's where I want those stocks. So check this out. This video would not be complete if I didn't look at this. Europe, United States, international. To me, when I look at revenue, Honeywell is more focused on the United States. This, in this kind of economic climate, is probably a good thing. There's a lot of borders being closed. There's a lot of international trade that's being slowed down. There may be that effect for a while. The world is becoming, from a country by country basis, a little less interconnected. And investing in companies, there's probably a little more safety to having just that pure play U.S. exposure. Now, I may be wrong, but in particular, what scares me right now is exposure to China, just because of trade war concerns. Now, I read something today that the tariffs may be temporarily lifted for international commerce into the United States. I thought I read that. Don't quote me on it, but I was excited to see that. But again, I just hope that after all of this clears up, that the countries are still, don't get me wrong, I really respect sovereign nations, and I think that's important to have different sovereign nations. I really think highly of that. At the same time, I think it's critical that our nations are respectful and can conduct commerce with each other from an economic standpoint. And so for me, I'm not saying it's a deal breaker or not, but if I'm putting Honeywell and 3M head to head here, I feel like Honeywell's got a little bit of an edge just where their revenues are coming from, just because there's more uncertainty at this time. That being said, my strategy has always been international in terms of having international exposure in my portfolio. And so it is what it is. There's pluses and minuses. When I look at all of this, I still feel a little bit better about 3M net, but certainly this could be a strength that Honeywell has going for it. Okay, so long-winded discussion there on the financials. I hope that's interesting to you all today. Please share your thoughts below. I know sometimes people criticize how I do it. Hey, I'm always looking to learn. I'll remain humble here. I'm going to be learning every single day. That's just what I do all day, every day, just sharing my journey here for fun and entertainment. That's worth mentioning as well. I'm not an advisor, not providing investment advice, just sharing my journey. And you probably are seeing me over the years evolve right before your eyes as I continue to learn more. And hopefully everyone else out there as you're on your own journey, you continue to learn more as well. So I want to move on. I got another topic to discuss. Let's talk about the ride or die stocks. I want to give a quick update, share them on the screen right now. These are my favorite dividend stocks. And I'm not going to go through them one by one. The biggest thing I want to share with you is what this week versus last week, the share prices in general are up. There has been a recovery so far. The PE ratios are up. Dividend yields are down. That being said, I still see some values out there. J&J still looks like a value to me. Duke, okay. Man, I wish I bought Coca-Cola when it was in the high 30s. I was waiting for it to get to low 30s and it didn't. Should have bought some in the high 30s. I was going to do it. I didn't. But props to all of you that did. 3M, I still feel it's a value. Kimberly-Clark, it seems to be in an okay range. Starbucks, I think the PE is really misleading because restaurants are just closed. But it's also more just a real premium company, so it tends to trade at a higher PE. I'm just buying it. But I'll be honest, it's not the best value out there. No, it's not. Home Depot, okay value. Basically, I highlight a lot here, but what I want the message to be here, I'm being real. The value's not there like it was last week. Already we're seeing that. I think, though, there could be further downside ahead where the value pops up again. And so right now, what would I feel comfortable buying for myself at least? It's really Johnson & Johnson, maybe some Duke, 3M, Starbucks, maybe some Kimberly-Clark. That's kind of where I'm at. Realty Income, by the way, it's down here. It's hard to compare because you don't value them on a PE. You value them on a price per adjusted funds from operations. But I don't really need more. I've got a lot of Realty Income, so I just don't need to buy more. And they do have some exposure to gyms, big tenants that are gyms. So for me to buy Realty Income, maybe I'd add some more, but it'd probably be down in the 30s. So that's where I'd be looking. And I have bought that low before, so I'm not in a rush to buy in the 50s, although I still love them, and they are on my preferred favorite ride or die stock list right here. So that's the quick update here. And the other quick update on this is as I compute this each week, I see the analysts for my PE calcs estimates typically dropping. I don't think I've seen too many of them going up. The analysts are revising expectations down, and that's going to be a trend probably for a while now. This is going to be a tough year. Okay, so what is going to happen out of all of this? What is next? I'm going to share my latest thinking on this. One, I don't know what's next, but what I do know is stocks now are cheaper than they were a few months ago. And so even though they've recovered a bit, I bought Starbucks today and I bought it more expensive than a week ago because it's still way, way, way cheaper than it was a few months ago. And so at a high level, I'm trying to take a step back and just continue to dollar cost average because in my opinion, we're still in this correction and it's still going to continue for a while. And even if it goes up and down within the correction, I feel like I'm still buying these stocks at corrected values. I don't have to time the perfect bottom. I just have to dollar cost average. So first and foremost, that's what I'm doing. Dollar cost average all day, every day, like the investor, thug life investor that I am. That's what I do. But really, what do I think is going to come out ahead? I get the sense that sooner or later here, at least in the United States, we're going back to work. I just think it's what I sense. I'm not trying to make a commentary here whether it's right or wrong. I get a sense, at least for people that are not senior citizens or people that have a pre-existing condition who are at risk, high risk, I feel that America will probably be getting back to work sooner or later within the next few weeks. That's what I believe. I believe when that happens, economic activity will pick up. And I believe that some of these shocks that the market is facing right now, such a main one being this virus, the shock value, the difficulty from it will start going away. Now, there's other shocks in the market now, such as the oil shock, the price of oil. That I don't know. I don't know when that's going to go away, but I'm talking more about non-oil companies here. I think stocks could start recovering when America gets back to work. It's possible. I think something, though, that could force stocks down further is if the pandemic doesn't resolve itself. It gets worse than we think. It doesn't fizzle away. An immunity out there is not built up, and it's here to stay for a while. Obviously, news on that front would be tragic, putting money aside from a human standpoint. The most important thing is human life, health. And so that's where, obviously we got to keep our mind focused. But that's something that could hurt the market. But let me tell you something. Just today, President Trump signed into law a $2 trillion stimulus package. And this is on top of the Federal Reserve lowering interest rate target to a 0 to a 0.25% range. So they dropped rates. And this is on top of the Federal Reserve greatly expanding their balance sheet by $4 trillion. And so what does it mean, by the way, when the Federal Reserve expands their balance sheet? It means that they're going to print more money. And they're going to use that money to buy assets from other people, such as treasury notes, for example, or making loans to banks and such. And so helping banks perhaps with distressed assets. And so there's a lot of stimulus happening right now on the form of $6 trillion. And what that tells me is, okay, there's probably some kind of inflationary effect. And what it also tells me is the government here in the United States is taking really, really bold moves to, look, this is serious. It's like there is a virus that has struck and it has caused $6 trillion worth of damage in the form of stimulus that must come from the government and the Federal Reserve. That's just mind-boggling. It's insane. And so all I'm saying, though, is $6 trillion, that's going to do a lot to prop up the stock market. And it's going to prop it up two ways. One, it's just a lot of money, so it's going to do some good probably out there for companies and such. But two, and hopefully for the consumer and the individuals out there, that's who my heart is with, is the small businesses. Side note, we just walked to a restaurant yesterday to do takeout, and it was so positive to one, get a really good meal, the best meal we've had in weeks, and two, to support a locally owned business. And people are saying, like, hey, isn't that risky? I don't think so. Like, they have it set up really good for takeout. And when we got the food, we practiced social distancing walking there. And when we got home, I put the food in the microwave and zap it for a little bit, heat it up, burn off any germs that might be there, perhaps. Although I do trust the restaurant that there's no germs. But even if there are, that's how I protect myself. I think it's fine. Hey, go to the supermarket. You could have germs anywhere on what you're buying anyways. So days of look, I'm doing my best to protect myself and my family, but at a certain point, you got to go out and grab a takeout from your favorite restaurant and support local businesses who need it the most. I love those guys. And if you're in the restaurant industry or local business, I'm praying for you. I really, really am. That's honestly one of the most, if not the most devastating side effect of all this, other than folks that have the virus. It's really sad. And I really hope the local economy, the local businesses snap back. But anyways, from a stock market perspective, I kind of see a few things. I see the president wanting to get people back to work, at least in the U.S. I see him, and we saw that in China, a quick turnaround. It's different. It's a different society there. They were able probably to quarantine people very easily, if you will. And so what I'm seeing here, though, is people getting back to work, $6 trillion. Possible inflation as well. This usually is a good thing for stocks. And so the way I look at it, quite frankly, is do I want to be holding cash, which the value could potentially get inflated away? Or do I want to own businesses that can charge more for their products during times of inflation? For me, I feel comfortable owning businesses. And so I believe that's what was reflected in the stock market this very week. I think that's one of the reasons that the stock market was up so much. It's not necessarily, these companies are going to do that well. No, it's more like, oh my goodness, $6 trillion flooding, floating around out there. Hey, do I want to be holding dollar bills or do I want to be holding companies? Beautiful, stable, premium operating companies. Now, there's all kinds of companies, but the ones I own tend to be really premium companies. And so, food for thought. What I'm kind of thinking is there's some scenarios out there. Maybe the stock market doesn't go lower because of all of this economic stimulus and because we may get back to work. The two things where I see potentially the market going lower is if just the pandemic gets a lot worse. And I surely hope it doesn't. The other thing that bothers me again, though, is international commerce is being shut down. So there's no airplane flights. There's less international trade, that type of stuff. For these stocks to fully make it back, they can't just survive on the U.S. economy. Some can, like Clorox. It's really just doing business in the U.S., North America. But most of my companies are international by design. I own international companies. And again, for those to really come back, we need to see a resurgence of economic activity internationally. And so I see pros and cons going forward. Generally, I'm more on the optimistic side here. And I continue to dollar cost average, and I continue to dollar cost average even at current prices because we're still down from the highs. We're way down. I think it could go lower. I'll buy more there. I could be completely wrong. Some people telling me, Ian, we're still in for the next Great Depression. And if we are, I'll be buying all the way down. And I'll be hopefully trying to find some humor in it with everyone out there because we'll need humor to get through a 70% or so decline. We'll see. Anyways, share in the comments below what you think is up next for our economy, for our world economy. I am praying for everyone around the world. My favorite part of this channel is that we are global. This is a global community. We have people here, subscribers from literally everywhere around the world, everywhere. And that's my favorite thing. I love everyone out there all around the world, praying for you all. For you, your families, your health. Stay strong. We will get through this. Before I leave today, in terms of full disclosure, I am long on the stocks mentioned today. I own them. I am long Johnson & Johnson, ticker symbol JNJ. PepsiCo, ticker symbol PEP. McDonald's, ticker symbol MCD. Clorox, ticker symbol CLX. Duke, ticker symbol DUK. Procter & Gamble, ticker symbol PG. Coca-Cola, ticker symbol KO. 3M, ticker symbol MMM. Kimberly-Clark, ticker symbol KMB. I am long Starbucks, ticker symbol SBUX. The Home Depot, ticker symbol HD. AbbVie, ticker symbol ABBV. Honeywell, ticker symbol HON. And Realty Income, ticker symbol O. I own all of those stocks in my personal dividend stock portfolio. Also, very, very important, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. Just sharing my personal journey here on YouTube for fun and entertainment purposes. If you enjoyed the video, please hit the like button, subscribe, comment. All of that means the world to me. Love you all. Stay strong. Praying for everyone in this community and beyond. I'll see you in the next video.